We love finding out where the market's got its consensus. What do you reckon it is right now?
Everyone's too bullish.
Yeah, well, that's what Matt reckons. We're about to dive in to hear views from 9 fundies, work out what they reckon the big consensus trades in the markets are for 2021.
Healthcare, that's your area of expertise. Consensus trades. We all love consensus trades. We talk each other into it. What's a consensus trade in your area as we go into 2021?
I think at the moment the consensus trade is mRNA vaccines. So who has made that? Everyone knows it, Moderna, BioNTech. They can repeat it back to me. I think that's a consensus trade. I think you also have a lot of excitement in a couple of biotechs around there. But overall, I think biotech is exciting. People now understand it's very important that you should have some exposure to that sector.
A consensus means it's going to go wrong, or people are just coming to realise what it is, the excitement about it?
I think there will be some people that will be surprised what they hold, because I don't think they have done the work. But overall, I think you can find good value in that sector as well. But again, it goes back to being selective.
It's got to be around interest rates, because I think that was the view that formed through 2020, where rates are going to be at or near zero forever. And everything was starting to get priced off that, revenue multiples, pre-revenue multiples. And although it will be the case for some time, I think the economy has held up a lot better than I thought it would. As I said, we're going to see stimulus flow aggressively well into 2021. The vaccination will start to get rolled out. And so there might be a re-evaluation of where rates are headed and if they're going to start to move a bit quicker. And it's something that you want to keep re-evaluating, because we know the impact it could have on asset prices if it's unexpected.
So quicker on the upside?
Yeah, potentially.
Well, I think the consensus trade is that we're all saved by these vaccines. I think the data has been better than anyone could have ever expected. 90% efficacy, but it's important to go. All it actually does is reduce your symptoms. There's been no testing so far as to whether it stops it being passed on, and I think everyone's got this consensus view, as you've seen in this rally in markets, that the vaccine's going to come through, everything will be back to normal again, our lives will be restored back to normal, whatever that means, and therefore economic activity restarts, and meanwhile the Fed's going to keep rates low, and inflation won't be a problem. I think that's the sort of consensus trade that you've seen that's lifted this tide of companies, really across the board. And I think, there are some potential risks for that, given we still have economic activity, that still has to play out while this vaccine rolls out. We still have the block and tackle of giving people injections. We still have to worry about, is the vaccine a genuine vaccine passport? And how does the economy go in the meantime while all that's taking place? So I think there's still a lot of water to flow under the bridge before we can, get as excited as potentially some parts of the market have already.
The consensus trade for a number of years has been low inflation, low bond yields, this duration trade that's been happening across equities and asset classes more broadly. I think the risk to consensus is that COVID has actually accentuated in the markets the sense that inflation is never coming back and that rates will be lower for longer. I think there's actually a real chance that COVID's actually going to be the exact opposite. We may well have seen the low in the US 10-year long bond back in March or April this year of sort of circa 30 basis points. We stand at about...
After 35 years, you're calling that?
I think it's the end. We've talked about this bull market ending. I think, that's the real risk, that we see a bit of a tantrum in the bond market at some point during calendar 21. Is it 6 months away or 6 weeks away? I think that could be quite violent and disruptive to the equity market for a brief period.
I think what you saw halfway through the year was this fear of missing out trade, where you had everyone just pile into reopening trades and retailers in particular, and they did extraordinarily well, and particularly the online ones like Temple and Webster. I think now what you're seeing is the pendulum swinging too far the other way, and it's almost like the fear of getting out. So you've had some fantastic trading updates from the likes of Adairs, Beacon Lighting, Collins Foods, and the stock price does nothing or actually goes down. And I think it's because the market's looking 12, 24 months ahead and really questioning whether that pent-up demand is still there, whether these companies can cycle that higher comps. I think for some particular companies, like Adairs, people probably underestimate that pent-up demand and the robustness of the business model to deliver growth throughout the cycle. So I think definitely kind of the consensus trade is this fear of getting out, but probably too early.
I think the most commonplace trade, at least over the last few weeks or a couple of months, has been this reopening trade, to tell you the truth. We've been seeing it build. We had early indications that might be there were positive readouts from the vaccine studies, and that led us into some approvals and into the vaccines finally being administered today, and some plans for them to be rolled out around the world next year. And you've seen cyclical stocks that were beaten up earlier in the year bid up a lot, and I mean sectors like brick and mortar retail, travel, leisure. These are all stocks which were beaten down, and some of them are probably going to make it through. There's going to be some, or a lot, that are still going to be susceptible and still have a lot of structural issues. And I'll give you a couple of examples. The cruise operators. So they had to shut down sailing earlier this year. Now, I don't think demand's going to come back to pre-pandemic levels. People just aren't going to cruise the same way they used to. But they've got to take delivery of a whole bunch of new large ships just at the same time that they've borrowed a ton of money and they've got a lot of debt on the balance sheet. And these are stocks that have doubled and tripled and quadrupled
They're too
off their
optimistic
bottoms.
out there for those
Way
recoveries.
too optimistic, and in fact, we think that they're actually great shorts for that reason.
The consensus trade is definitely sell the COVID winners and growth and buy the dirty value. And, you know, my experience with dirty value is that there's some pretty dirty value.
I thought it was
and,
deep value, but
I prefer dirty value myself. And you can tell I've got a slight growth bias. So that's definitely been the consensus trade certainly in the last, since the vaccine news came out.
So go back to growth, do you think?
Quality growth is always a winner over the long term, in my view.
Everyone's run into tech, and they've all run into the COVID beneficiaries. So it's a very crowded trade in those two parts of the market, and they're not mutually exclusive. And that's the places we're avoiding. We're finding good value in sort of the older world, the more traditional type industrial businesses. We own some companies that are quite cyclical, exposed to housing or materials, etc. And we're seeing good upside in those sectors.
Well, we've been watching tech stocks with a lot of fascination. I think the market is, on a whole, buying a lot of good storylines and good top lines, but not necessarily looking at the bottom line or the returns. So, looking through the universe of Australian tech companies, there are actually very few that we think have been beneficiaries of COVID. We've seen lots of examples of sales cycles being lengthened, about high customer churn during this period, about discounts having to be offered to customers. So it's yet to be proven whether they're actually benefits of COVID. And the other thing that I think people need to realise is that R&D is a real investment. So the return on this R&D is quite ambiguous at this point. And a lot of that is that being capitalised. So you don't see it in the P&L, but you do see it in the cash flow. So I think investors need to be quite discerning when it comes to looking at tech companies.
Well, I think it might be the other way around. I think the consensus trade is that the Australian consumer or stocks exposed to that consumer are over-earning. And there's a little bit of that, but I think it's overdone because we had a Banking Royal Commission, we had a credit crunch going into COVID, and I think that's relaxed. And I think the consumer who's saved 19% of their income, which is off the Richter scale, is ready to deploy again. I think all those retailers that have been sold off, the funds, the cyclical stocks, they'll do quite well this year. And I think the mortgage market will be a boom market over the next 18 months.